Good morning, it's Sunday, and I'm Rabbi Danyiel, and I would like to extend blessings to anybody watching today. I hope and pray that things are going well for them, and today we're going to continue with this financial, biblical keys to success, financial things that are, you can see through Scripture themselves. Last time, previously I spoke about creating your own business. I spoke about understanding tax law and taxation. I also spoke about insurance and the importance of insurance. And now today I'm going to be talking about real estate and the importance of real estate and what the scripture actually has to say about real estate. So we really got to learn the real estate game, and in the US here it is a game. So we're going to start off, and I'm going to read from Psalms 115 verse 16. And 115 verse 16, it says, "As for the heavens are Hashem's, but the earth he has given to mankind." Okay? We are supposed to be the stewards, the keepers of the land. We're supposed to take care of the land. We're supposed to, at the very beginning, God places Adam in the garden, and he is supposed to take care of the garden. He is supposed to tend to the garden. Everything ultimately belongs to God. That's why in Genesis it says, in the beginning, God created. Everything belongs to God. But he has given us to take care of it and to possess it and to build upon it and to have our sheep and flocks and herds upon it, and to have our farms upon it for food. The next one, I'm just going to give a couple here. So the next one is in Proverbs, and it's Proverbs 31. This is related to the woman of valor. It's Proverbs 31 is often referred to as the woman of valor, and it's a poem. And so in verse 16, so that's Proverbs 31:16. It talks about what the woman does. She envisions a field and buys it. From the fruit of her handiwork, she plants a vineyard. Okay, so she actually goes out and she buys the land. And she does something with the land that can bring money back into the household. She doesn't just buy the land and live on the land. She buys the fields, so she buys the land in order to plant upon it, in order to bring in upon it. In other words, the key here that she does is she takes what would be a liability and she actually makes it an asset. So let's get into that. Let's see, what is an asset? You're taught in modern accounting classes a fallacy. And the fallacy you're taught in modern accounting and business classes is that anything with value is an asset. So if you go buy a house, then you have equity on it, then that's an asset. Actuality, that's not how rich people think about what an asset is. That would be considered a liability. So, and there's plenty of rich people that talk about it. One famous guy, one famous landowner, landlord that talks about it is Robert Kiyosaki. He says, rich people don't think about asset in the traditional sense that a school's going to teach you. School's going to teach you an asset is something that has value. A liability is something that you owe upon. And that's not exactly correct. That's to one definition, but that's not really a correct definition, because that doesn't allow for money to really flow. An asset is something that puts money, a positive cash flow, into your pocket. And a liability is something that strips that out. So there's a lot of things that can be both. So a house can be both an asset or a liability. It depends on how you use it. If you buy a house to rent it out, that's an asset. It's giving you positive cash flow. If you buy a house to live in it, it's a liability. It's eating up your funds. Okay? A whole bunch of hidden costs that you don't know about, and the loss of opportunity costs that you could have done other things with. Don't get me wrong, in many cases it's still better to own than it is to to rent, because when you rent, you're still losing a lot of money. But renting has its places in the tax law, so that's where it gets really unique. So there's a concept called rent where you can buy, and buy where you can rent. Because see, the really wealthy don't actually buy their homes. They rent their homes. And this is how it's done. So they form and create an LLC, a company, or something of that nature, an entity. The entity buys the property. And then what they do is they rent to themselves from the company. So they buy ABC company, they own ABC company. ABC company buys the land, and then them as individuals, they rent from ABC company. That way they can write off their rent as a tax write-off, as square footage used for their house to conduct their businesses, right? But at the same time, they are able to make the money off of it and build the equity in it. So this is how it's done. There's a lot of creativity that goes on with real estate and what can be done with real estate. So it's very important to understand an asset and a liability. Another example of an asset, a liability, a thing that's a straight up liability for most people is a vehicle. You get a vehicle, it's a liability. However, you get a vehicle which is a truck in order to move and haul goods and freight. That truck then no longer is a liability at that point. It becomes an asset because that asset is starting to produce revenue and income to bring back in. So if you buy vehicles in order to rent out the vehicles, you've created that, took that a liability and you made it into an asset, and now you're making positive cash flow off of it. So understand, asset, something that puts money in your pocket. A liability, something that takes the money out of your pocket. And that is the best definition for understanding what an asset and liability is, to keep yourself from getting in trouble when you're trying to grow money, when you're trying to make wealth, and when you're trying to produce wealth. So that's where I've heard Grant Cardone say before, rent where you can buy, and buy where you can rent. So what does this mean? Rent where you can buy. Well, of course, you're going to rent yourself for your own house because it's going to be tax write-offs, and you're going to be collecting the money back end. You're going to be saving the money from the IRS confiscation on the back end. So that's very important. But you want to do it in a comfortable place where you can enjoy your family style of life, you know, a good standard of living, and a safe neighborhoods, areas, places. But you want to buy where you can rent because you're going to take those purchases and you're going to rent them out. And as you rent them out, nobody wants to rent a house for, you know, common people can't rent properties in $4,000. So you want to buy properties in which you can rent them out for $1,000, $2,000, depending on what city you live in. Here in San Diego, average rent prices are anywhere from $2,000 to $3,000 a month. It's crazy out here in San Diego. But that's what happens there. So it's very important. Lesson, entrepreneurial lesson, rent where you can buy where you can rent. And I do believe it was Grant Cardone that I heard say this. Next thing, why is it called real estate? Why is property and land things called real estate? Because it's an estate, and because it's real, it's tangible. It's not like fiat currency that goes up and down, and stock markets that you don't know what's going on in. Stock markets have a lot of things, and they're just like, what is going on? And one of the things that bothers me the most in accounting is you'll have a concept called goodwill. Well, goodwill is just made up numbers, made up money into the financial statements, and it just drives me insane. It's like, well, where does this money come from? Let's just make up some money. Okay, so let's value the company, and they say goodwill. it's goodwill. Oh, okay. What's goodwill? Are you telling me that just now there's money popped in there? When you have stuff like that, things could fall apart. It's inflated cost. It's inflated. It's not really there. It's not solid. It's not tangible. Gold is spoken about in Scripture because it is solid. It is tangible. It is a precious metal. It is. You can put your hands on it and hold it. Most commodities are that way. Although commodities can go bad, you know, such as potatoes and rice and vegetables, they can go bad. So it is a commodity, but it can go bad. Gold and silver can actually go bad. It's solid. It's like oil as a commodity can't go bad. It's good. You can still use it. You can still do something with it. And property itself, land, real estate, buildings on it. Although there is depreciation costs and things of that nature, it's still real. You can hold it, you can touch it, you can feel it. That's why it's called real estate. And that's where the true real, not fake stuff is. It's in real estate. So what types of real estate investments can a person get into? Well, if you're on the conservative side, you don't want to, you're afraid about losing money, and you don't have a lot to play with, but you want to get into the real estate game. You can get what's called a real estate investment trust, REITs. Okay, they usually pay about 3 to 4% quarterly returns. They pay dividends on that. You can recycle the dividends back into your portfolios. You will be taxed on that when tax time comes, and so the taxes will eat away on some of the growth there, but it is very conservative in nature. And if a person wanted to get into that, they can use a company called Rich Uncles, which can help them get into that. You can also buy properties in order to flip them. You can buy regular properties on your own credit. This isn't the best thing. You buy it on your own credit. You go and you buy a fixer-upper. You live in it. You fix it up. Boom. And then you take the profits from that, and then you move on that. You kind of get the momentum. You build another one, etc. You flip a few of them a year as you can. There's a concept I learned that's really great. It's called quadruplex or more, and that's basically when you get yourself a property, you get yourself a quadruplex, you buy a quadruplex, you live in one of the spots, and then what you do is you rent out the other 3. And when you rent out the other 3, you just basically set all the costs, all your accounting for the overall complex, and then you just, instead of dividing it by 4 and including your own cost in it, you divide it by 3, and then you basically spread that 3 over the 3 people that are the 3 other apartments in the complex. And then what happens there is then you have the positive cash flow that's covering your own expense, and as you're living in the one, they'll cover the rent, they'll cover utilities, they'll cover everything you can imagine that will go into the property, all your costs divided by 3, and then spread it amongst your tenants, and then you yourself, you're walking away with your free rent, your free utilities, you're making the equity on the property. That's called the quadruplex concept. It's actually a great concept for vets coming out of the military that have great credit scores, because they can put up a proposal, give it to the bank with a great credit score. They're probably going to get approved for a nice quadruplex. You get the quadruplex, you start renting it out, you become a landlord, and you start building off of that. Yeah, you got to deal with plumbing issues and other issues. So, but there's all types of other ways to make money in the industry. It's a starting point. It's a good place to be. And of course, then you build upon it. I mean, not everybody can jump in like Grant Cardone and buy, 100-unit, multi-unit complexes or more than that. You got to build up to it. And so this is a way that some people can actually get into the game. Now, I specifically remember when I was in the Army at Fort Bragg, there was a guy I met at a congregation. I didn't want to live in the barracks anymore, and I was looking around for rooms. And I met this guy at this congregation. And this guy, what he did was he had this huge mansion. I could tell you, this massive house. It had 10 rooms in it and stuff. And literally, he would just rent out all the rooms. He was a single guy, wasn't married, didn't have kids. And he thought to himself one day, well, I buy this property and I got 10 rooms in it. I can rent out 9 of them, and that will cover all the costs for everything that comes in the house. And that's what he did. So he furnished the place. He paid for got all the furnishings in the property, and that's what he did. He rented that out to 9 other people. They come in there, just guys in the military that were religious in nature but didn't want to live in the barracks because, how the barracks are. They wanted to get away from that military setting because they want to focus on their spirituality or something to that effect. They wanted something different. So that's what he would do. He would set this up. And he would make sure that, he covered all the food, he covered everything. It wasn't all inclusive in the cost. But from that, he was able to spread those costs over the 9 rooms. And of course, he's walking away with the equity, with the property, with the ownership of the house. And he's walking away with all his expenses covered. And great tax write-offs on the whole thing. So very wise in how he did that. I don't know how he started off with that as such a big purchase of property, but that's a concept as well. That's the same concept as a quadruplex concept. You can do it in the houses, and you can rent out. You can sublet, which is if you're renting a place and you have some extra rooms that you don't actually use. You know, a 3-bedroom house, but it's just you now, or you and your wife, because your kids grew up and they went out, and you're renting a place. Then sublet the other rooms that are not being used in the property. When you do that, then you're lowering your cost on the property, and you're making your rent a lot cheaper. So one way to do it. Another way to do it is called the tax lien certs. So the tax lien certs, this is set by state legislative law. And state legislative law says, like Texas, it's 25%. So you buy a lien, you buy a tax lien, and they got a redemption period in it, and you're basically paying somebody else's taxes so that the local governments can run and function. And you're buying the property owner time to pay their taxes. Most likely, if there's a mortgage on the property, they're going to come in and pay it off, because a tax lien is the first number one line. It's first charging line. So once you buy the tax lien, you're the first charging the line on that, which means that if they don't pay the property taxes, you're going to get the property for pennies on the dollar. Pennies on the dollar. Okay, so because the counties are going to require the property, take the property, and you're not going to see the tenant, you're not going to know the tenant, you're not having any experience with the tenant, nothing, anybody in the property, nothing like that. So property taxes are a huge issue. So you got, like in Texas, it's legislated 25% annually. Illinois is 36% annually. The high other states are like Arizona and Florida. South Carolina is 3% per quarter. So that's, first quarter 3% jumps up to 6%, jumps up to 9%, jumps up to 12%. So these are great deals. Tax liens, you can buy them through assignment purchasing. That's after the sales. Are there any leftovers from the auctions? And leftovers isn't a bad thing. It's just, they have these auctions, they don't have enough people there, they don't have enough people there, they don't have enough capital to buy up. That's how many there are. There's so many of them. And this process has been going on for a couple hundred years. Literally, this process is because the counties need to run, and that's how they do it. Property tax, you got to be careful on your property taxes. That's another vet perk, is if you're a disabled vet, certain states will waive your property taxes, and then you don't have to worry about that if you're the owner of a property, if you get behind on property taxes. But if there's a mortgage on that property, the mortgage company's going to step in, the bank's going to step in, because they don't want to lose the property for pennies on the dollar when they can save the property. So more than likely, you're just going to get the percentage increase, which is the fee, basically, that the county had already charged to the person that owns the property tax. And so you can end up, and some of these are just like short payments. So like in Illinois, I saw properties that are like business properties. It's like, no way is they're gonna let this go. They just, when they paid their tax bill, the property tax bill, they didn't completely pay everything. They short paid to the county, and then later, like, probably a mistake. Well, I don't know. But then the county puts a lien on it, and then they realize, oh, we got the lien. Okay, we got to pay the lien, and then they pay that extra money. So you could buy large properties for pennies on the dollar. More likely, you're just going to get your percentage. So, but tell me where else you're either going to get your percentage, or you're going to get the property. And tell me where else can you get a returns of 25%, 36%, 12%, 16%, 18%, depending on the state. Every state's different. And not every state is a tax lien state. Many of them are tax deed states. So you actually do get the property on a tax deed state at auction or resale after auction for pennies on the dollar. Tell me, there's no stock out there. There's no mutual fund out there. There's nothing out there that can give you such great returns. And I wonder how insurance can guarantee. This is how insurance can guarantee. Absolutely, this is how insurance can guarantee. Okay, so the last one is VA perks in real estate. Like I said, there's a percentage difference on the state percentage. Like certain states, it's a lower percentage of VA disability. Other states requires a lot more. So states that are very friendly to vets: Texas, Nevada, Arizona, Florida. You can get pretty cheap. The the vet has a pretty low percentage on their VA disability, then they're able to get a cheaper, or no property taxes, required for them. California, you need 100% VA disability, and then you don't have to pay property taxes up to a certain point. But still, I mean, this is massive. This is a game changer for vets, and they really need to pay attention to that. Also for vets, you can get 0 down purchases, and this works great if you're going to try the quadruplex idea, or like the guy I spoke about Fort Bragg earlier, or the renting out rooms out of a large home. These are all great ideas. And if you're a vet, 0% down, wow, that's a huge thing. So with that, this concludes my topic about real estate. I covered a lot, and we saw some biblical things, and we actually saw in Proverbs 31:16, where she buys the land. Okay, so she buys the liability, but it's to plant a vineyard, which is to turn it into an asset. And that's what you want to do with real estate. You want to, again, rent where you can buy and buy where you can rent, as Grant Cardone says. With that, I pray that everybody listening is blessed. You've learned something, and you can go forward and apply it and somehow learn the rules of the game, of the real estate game, of the monopoly game, the real estate game, and get in there and get something done. You don't have to just wait around to try to buy a house. Because if I would have waited around in San Diego, I'm never going to buy a house. Because San Diego, the property is a traditional way through the roof, and I'm not going to get there. So there's a lot of ways and techniques to get into the market. With that, be blessed. Have a blessed day, and until next time.